Welcome back to Investing Talk Podcast.
Today, we're looking at Centrus Energy.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For those of you tracking the energy space, Centrus is a really fascinating company. It sits right at the intersection of two of the biggest tailwinds in the global economy right now.
Okay.
First, you've got this undeniable nuclear energy renaissance happening. And second, there's this huge politically driven shift away from any reliance on Russian uranium.
A huge geopolitical angle.
Absolutely. When you look at Centrus, you're looking at a company that is, well, it's becoming absolutely critical to the future of U.S. energy security.
That sets the stage perfectly. I mean, we've seen a massive surge of interest across the whole uranium sector lately, right?
Yeah.
From miners to enrichers.
We have.
But if you're an investor looking for exposure, why Centrus specifically? What's the key differentiator here? What separates them from, the usual names we might talk about, like Cameco or Energy Fuels?
Well, it really all comes down to a single proprietary concept.
Okay.
This is their competitive moat. High-assay, low-enriched uranium, or LEU, as you'll see it called.
HALU.
Right. Centrus isn't just another player in the market. They are the only company currently licensed by the U.S. Nuclear Regulatory Commission to produce HALU domestically.
Wait, the only one?
The only one. That makes them a uniquely strategic asset.
That is a staggering advantage. I mean, it's not just about digging ore out of the ground. This is like highly specialized, high-tech manufacturing with these incredible geopolitical and regulatory walls around it.
Precisely.
So can you break down HALU for us? Why is it so critical for the future? What makes it different?
Absolutely. So HALU isn't the standard fuel you find in today's big light water reactors. That standard fuel is enriched up to about 5%.
Okay.
HALU is enriched between 5 and 20%. And that difference, it's foundational. It's basically the high-octane fuel required for the entire next generation of advanced reactors.
The SMRs. The small modular reactors.
Exactly. The SMRs, that higher enrichment level lets them run hotter, operate for way longer between refueling, and generate more power from a much smaller footprint. That's the whole selling point of this new tech.
So they don't just have a proprietary technology.
Yeah.
They're literally fueling the next technology that the entire world, and especially the U.S. government, is betting on for decarbonization.
You've got it.
That has to translate into just an astronomical market projection then, right?
It does. And this is really why the investment thesis is so compelling. This growth isn't just, organic demand. It's being strategically mandated.
Give me the numbers.
The HALE market is projected to be worth around maybe $0.26 billion in 2025, which is tiny, really.
Pretty small.
But you fast forward 10 years to 2035, that market is expected to skyrocket to a massive $6.14 billion.
Wow. From 0.26 to over 6 billion.
Yes. That kind of exponential trajectory is exactly what investors are pricing into the stock right now.
That growth forecast alone is, it's a powerful long-term thesis.
Yep.
But you and I both know investors can't just live on promises. Let's ground this in reality.
Good idea.
What did the actual recent numbers, say Q3 2025 financials, tell us about the health of the business today?
Q3 was definitely a mixed bag. It showed both their core operational strength and the volatility of their older legacy business.
How so?
So revenue came in at $74.9 million. Now, that was up substantially year over year, which is great. It was driven by really strong performance in their existing low-enriched uranium, or LEU, segment. That part jumped 29%.
Right. There's always a but. The market noticed that 74.9 million just slightly missed the analyst consensus. I think it was closer to 79 million.
It was.
So that's the mixed signal right there. A miss on the top line, even with that strong segment growth.
Correct. But they made up for it beautifully on the bottom line. Net income was $3.9 million, which translated to an EPS of 0.19.
And the consensus was what, like 8 cents?
8 cents. So they handily beat the estimate, which suggests, excellent margin and cost management. However, we have to look deeper into that revenue mix.
Okay.
While LEU was strong, their separative work unit, or SWU, revenues were down a really concerning 69%.
Whoa, 69%. That's a huge drop. For our listener, can you quickly explain what SWU is and why that's a red flag?
Sure. Think of SW as the unit of measure for the energy and time it takes to enrich uranium. It basically measures the work being done.
Okay, so it's a measure of their service.
Exactly. And that 69% drop in revenue suggests they're facing serious pricing competition, likely from international sources, in that legacy business. It really confirms that their entire future is tied to HALEU and the Piketon expansion, not their old contracts.
That is a crucial distinction. It really highlights the high-stakes bet here.
Mhm.
They beat on earnings, but the old business is getting squeezed on price, forcing this massive pivot to the future.
That's the story.
Which brings us back to the core challenge. The money required for that pivot. How healthy is the balance sheet that's supporting this massive expansion at Piketon, Ohio?
This is truly the key element of the bear case. I mean, Centrus carries a high total debt-to-total capital ratio of 0.77.
0.77. You can't ignore that.
You can't. If you compare that figure to major industry peers, Cameco is sitting around 0.13.
So a fraction of that.
A fraction. And Energy Fuels is virtually debt-free. So Centrus clearly stands out for its high leverage. That signals significant risk if the HREU execution hits any delays or, cost overruns.
A 0.77 debt ratio isn't just high, it's genuinely concerning for a company in the middle of a huge capital project. If they're so leveraged, what's the plan for financing Piketon? How are they managing that risk for investors?
The risk is substantial, but it is somewhat mitigated by two incredibly powerful factors. First, they have a huge and proven backlog of $3.9 billion.
Okay, so that's secure future revenue. A cushion.
It's a cushion. Second, and this is where investors really need to pay attention, they recently established a $1 billion at-the-market equity offering program, an ATM.
An ATM offering. That gives them a ton of flexibility to raise cash, but for our listeners, that immediately signals dilution, right? They're selling more shares into the market.
It does.
So how should we weigh the need for this capital against the risk of watering down value for existing shareholders?
That is the essential trade-off, and it's exactly why Centrus is such a high-stakes growth play. Dilution is a certainty, but the purpose of the funds is key here.
What are they saying it's for?
The company is explicitly signaling that this ATM program is for working capital and, most importantly, for growth reinvestment, specifically in that Piketon enrichment expansion. They are firmly in growth mode.
So no dividends, no buybacks.
None of that. They are prioritizing building that domestic HALEU supply chain over everything else. For a long-term investor, you have to decide if the value of securing that national monopoly outweighs the near-term increase in the share count.
Well, I think the market is answering that question for us right now. Despite the debt, despite the potential dilution, the stock has clearly reflected this bullish future.
It absolutely has.
Investors have not been ignoring this HALE mode.
No.
So on the market side, how explosive has the momentum been? What catalysts have fueled it?
The momentum has just been spectacular. As of late 2025, the stock has soared an astounding 297.1% year-to-date.
Almost 300%.
Almost 300%. To put that in perspective for you, the S&P 500 was up less than 19% over that same time. This shows overwhelming conviction from the market.
And there was another catalyst recently, right?
Yes, a major one. The company successfully uplisted to the New York Stock Exchange effective December 4th, 2025. This is huge. It dramatically boosts their visibility and liquidity. It makes the stock accessible to large institutional funds that, might have been restricted from investing before.
A near 300% gain suggests maximum conviction, which of course also means the risk of a pullback is proportionally high. For investors who feel like they missed that initial surge, technically speaking, where are people looking for potential entry points?
Well, if we connect this to the bigger picture, the price action shows a really robust multi-year uptrend. Technical analysts are looking for strong support zones after these recent pullbacks. There was a recent low around $243.48. That's the first logical support line people are watching.
That's a very specific tactical level.
It is, but the broader psychological zone that I think institutional traders are really watching is closer to the $200 mark.
$200, okay.
That $200 area is being viewed as an attractive base for entry. The thinking is simple. If the market truly believes in this multi-billion-dollar HALEU thesis, then a reset to $200 after a massive run-up is seen as, a necessary pause before the next leg up, assuming, of course, that Piketon execution remains flawless.
Let's pivot to that flawless execution part. Let's address the bear case head on. We've covered the high debt, but what else is challenging this steep market valuation?
The primary concerns are rooted almost entirely in valuation. This is the main talking point for any skeptic right now. Analysts point to a forward price-to-sales ratio of 9.94.
Nearly 10 times forward sales. That's an enormous premium. What's the justification for paying 10 times forward sales when the industry average is, what, under 4?
It's the LEU monopoly, pure and simple. But that valuation disparity implies that Centrus has to execute perfectly and capture that huge market share without any delays. The valuation is extremely stretched. It suggests a decade of success is already priced in.
So there's basically no room for error. And we talked about the pressure on their legacy SWU business earlier. Does that valuation concern combine with any issues in near-term earnings that might spook the market?
Absolutely. The forward-looking financials add another layer of caution. Analysts are projecting a potential dip in 2026 earnings per share to $3.70.
A dip? From what?
That's down from the projected $4.58 for 2025.
Wait, hold on. If they're trading at this massive premium and their main growth driver, HAAU, hasn't even hit its full stride, why would earnings be projected to dip next year?
It's the cost of growth combined with the volatility of the old business. Capital expenditures for Piketon are intense, and the pricing pressure we talked about on the SWU side directly hits the bottom line of the existing business.
I see.
So that combination, the steep valuation and the projected earnings dip, is exactly why institutional options flow remains skeptical. We're seeing roughly 50% of the institutional options flow over the last 3 months has actually been bearish.
Using puts, I assume.
Using puts, either to hedge or to bet against the momentum continuing, that's a significant indicator of institutional caution, even with the huge stock gains.
Okay, so to synthesize this complex picture for anyone listening,
Yeah.
we have this massive proprietary moat. They're the only domestic HALEU game in town.
Right.
They have huge funding secured. But offsetting all of that, you have significant debt, pricing pressure on the legacy business, and a steep, steep valuation that demands immaculate execution. What should we be watching for in the next few months to judge if the bull case is on track?
The focus is going to be entirely on the catalyst calendar for the first quarter of 2026. The biggest event, obviously, will be the Q4 2025 earnings report. That's likely in early February 2026.
And what are we looking for in that report?
We need to see sustained, robust demand for low-enriched uranium, but more importantly, we need to see concrete progress on emerging HALEU milestones. We need proof that the capital is translating directly into operational readiness at Piketon.
Makes sense. What about the external environment?
The external environment is critical. We're watching how the U.S. continues to move toward regulatory action, potential outright bans on Russian uranium imports. Every step the government takes to secure the domestic supply chain just reinforces the Centrus thesis.
Right.
And we also need to track how fast the overall nuclear sector rotation accelerates. If utilities start signing contracts for SMRs faster than people anticipate, it just lights a fire under the HALE demand curve immediately.
This has been a fascinating and really specific analysis. It's a company that's defined by this strategic, one-of-a-kind advantage balanced precariously against huge execution risk. The real question here is whether Centrus can execute on its HALEU pipeline fast enough to justify that current premium valuation. It's a compelling, high-stakes, multi-year hold thesis driven entirely by the promise of next-generation nuclear fuel, a future that is being built right now in Piketon, Ohio.
If you found this discussion valuable, be sure to subscribe so you don't miss our next analysis. We appreciate you joining us for the discussion today.